Welcome everyone, I'm James, I'm the CEO of Nuwaru, and I'm going to take you through some of the tax considerations associated with scale-ups. Now, when we look at scale-ups, generally what we're looking at is some of the structures that people typically have or want to move to as part of their scale-up, and several of the benefits that might be available to them as they scale up and increase their business. So if I turn to the first one, looking at structure and what does a typical scale-up structure look like. Typically, we'll have a founder structure over the top that will have the shareholders, and it may be held via discretionary trust or could still be held in individual names. And then below that structure is really where it gets interesting. The questions that come up are, do we have a holding company? Do we hold the IP separately to some of the other entities within the group? Do we hold it off to the side directly? And I'll explain in a little bit why some of the tips and traps around structuring you might want to hold IP off to the side. And then usually the most common question we have is around, what do I do with the consumer facing, my sales entities? And what do I do with my sort of more internal service entities that might have things like my property or my employees? So if I look at the typical structure, often people want to segregate out different aspects of their business into separate legal entities. Why do they want to do that? Well, let's flick to the next slide. So the first thing is, what's the benefit of having a service entity? Why do I have it? Well, most people want to, from a risk perspective, segregate the risk associated with their people. And so that's risks of employment law or being sued for various things in relation to your employees, as well as some of the things around leases and rental bonds. So they limit exposure by having what we typically refer to as a services entity. The second part that they look to segregate is, and this is the most common one, is around intellectual property. They want to hold that in a separate entity because it's perceived as protected, and then they can license out or share that intellectual property and enable other entities within the group to use that IP whilst holding it under corporate veil within a particular legal entity. The final thing around looking at structuring is they want to have different pieces of their business that are available there, are segregated and available and efficiently can be segregated from the business through a sale or exit. So if I look at the tips and traps, and we'll come back to the group structure as to what this actually means and why it's relevant to the group structure. The first one I often say, when people tell me they want to have a separate IP entity, is that they want it segregated so it's protected. The interesting thing, and this is a real trap for young players on this, is how protected is your IP? Because having an IP asset held within a legal entity is protected to the extent that that entity is not a subsidiary of another entity, because then it becomes an asset of that entity. Or secondly, having IP segregated within a particular entity is great, but other entities need to utilize that intellectual property, be it a trademark or a patent. So what you end up doing is having intercompany licenses or agreements to enable other entities within the group to use those. That right or license is valuable. And so whilst you've segregated the asset in one entity, you have the right to use it in another entity. And often you need this in your sales entity. That's the entity you're trying to protect it from. So whilst you've segregated the IP, now you have a right to use the IP, which is a valuable asset, in another entity. So what you need to think about is, well, how do I structure that right or license to cut off that ability and therefore reduce the value in another entity of the ability to use that license or right, should something occur under which someone has a right to acquire or assume or sue for that particular right. And so looking at how protected your IP is a key consideration. Simply throwing it in a separate entity is not enough. You've got to look at the broader structure. The next thing looking at a structure is, why do I do all these things? And people often think tax is the driver. But interestingly, the tax on a scale-up structure is usually simplified by tax consolidation. So often what we'll encourage clients to do is to look to consolidate as much of their group as they can, simplifies the administration, it ensures that loss entities within the group can easily share losses amongst entities. It makes intercompany transactions essentially ignored from an income tax perspective. But consolidation also throws up some problems. So consolidation only works where you have 100% entities. And this is where, if I turn back to our our scale-up structure, you run into a divergent path. If you want to hold everything in a consolidated group, you essentially need to have it under a holding company. Whereas if you want to look for a benefit of CGT discount on disposal, that won't flow through 100% subsidiaries. And so you look to use a structure which we often refer to as a parallel structure, whereby shareholders hold an interest in a portion of the company and perhaps separately hold an interest in the IP owning entity within the group structure. Now, if they do that, because the shareholders hold both, it's not 100% subsidiary, so you can't consolidate. But you've segregated the ownership between the shareholders, therefore they both own them, and they can sell one or the other piece separately. And because the shareholder holds the entity directly, they can access things like CGT discount. So whilst consolidation is helpful, it doesn't solve all problems, and indeed trying to force things into consolidated group can put at risk things like CGT discount for sales of portions of a business. And so that's why sometimes you might want to move to a parallel structure rather than a very simple consolidated group with a holding company at the top. The other thing that people often ask about is GST grouping and why. It's very common for groups to group from a GST perspective. The main purpose is really administrative. There is reasons from a structuring perspective where you might have input tax suppliers and things like that within the business. But for relatively straightforward businesses, GST grouping is usually administrative concession. It means that you can essentially not charge GST on intergroup transactions, and you prepare one BAS for the whole of the group. So that's typically something that will be done in conjunction with income tax consolidation. Another piece, and this is a real trap, and we see this quite often, particularly around companies that do focus on R&D or tech, that are looking to claim the ESIC concession, and I'll talk about that in a little while. But you need to be very careful with the ESIC concession and the entity in which you conduct R&D. If I go back to the typical holding structure, if I have a holding entity above the entity that holds my IP, I may have trouble claiming ESIC concession for investors. So I'll touch on that one in a little bit, but that's certainly something to think about in terms of initial structuring for a scale-up. The final piece in relation to grouping is really around losses. And my messaging around losses is to think about them early. There is a lot of traps that can occur when you look to group later in the stage of a scale-up in terms of your ability to both transfer and utilise, as well as the rate at which you can utilise losses into the future. So moving entities can cause problems in relation to ability to use losses, and also having loss entities coming into groups can have problems under what we refer to as an available fraction, where whilst the losses may technically come into the group, your ability to use them might be significantly, if not completely, diminished. So consolidating early and getting your group consisting of both your income deriving and potentially your loss entities is a real saving strategy that, if left to later stages, can cost you the ability to utilise losses, and they can be incredibly valuable, particularly in scale-ups that may have had them incurred from quite early on and may only turn profitable later. So consolidation is certainly something that can help solve those and should be looked at earlier rather than later. The final piece is when looking at structuring and grouping, where you're starting as a single entity and adding on additional entities or restructuring the group. Transfer of assets post-consolidation is relatively unconsequential and should be mostly within the group and ignored from an income tax perspective. One of the traps people fall into is stamp duty. Stamp duty doesn't have the same grouping provisions. There are some corporate reconstruction relief. They are in some jurisdictions available in totality. In other jurisdictions, they're only available to an extent. And it's not laid out misere that group restructures will actually get you that stamp duty relief. So whenever you're moving ownership or transferring entities, you need to consider stamp duty. It's an issue that people often neglect and can come back to bite them post-group restructures. Losses is always an issue in relation to moving entities. Post-consolidation, again, should be relatively inconsequential, but pre-consolidation can cause issues in relation to what we call the continuity of ownership test, and therefore can force reliance on business continuity, same business test, which is a lot more difficult and is reliant on the business undertaking basically relatively the same sort of business over a period of time. So what we look at when we're trying to get businesses essentially into that scale-up structure often is around some of the concessions, around rollover relief, to enable us to form groups in a structure that makes sense commercially and also takes consideration of some of those trips and traps that I've talked through earlier. So one of the benefits that we're usually asked about is R&D. And look, I won't profess to be the R&D expert. We actually have an R&D partner in Nuwaru, and I will deflect all questions and accuracy to that partner, but I'll give you my 2 cents on R&D. Basically, R&D is an incentive program. It depends, the benefit really depends on your turnover, whether you're under or over the 20 million threshold, and essentially provides a tax offset in relation to the amount that you spend on R&D. So if it's a refundable tax offset at the company's tax rate plus 18.5% if you're under the 20 mil, it's a varying rate if you're over the 20 mil, and you can see the definition and the benefit in the slides there. I won't repeat it. In terms of tips and traps, and this, as I said, is coming from a non-R&D expert perspective, but this is what we always hear. And R&D is a broad term, and most startups think what they're doing is true R&D, but one of the, and a sole principle is there must be innovation and it must be experimental. And the easiest way I often hear to think about that is to go back to, the science projects that you used to do when you were young at school, in terms of, there has to be a hypothesis, there has to be a number of risks associated with what you're doing. You're testing theories, you have outcomes, and that's the sort of mentality you need to go into when you're thinking about R&D. The second thing, and this is often where people fall down, there may be R&D, but what they don't do is document it. So paperwork, unfortunately, is a key aspect of R&D. It's often a piece that most scale-ups don't look forward to, don't want to do, wish someone else would do it, but it is key to a successful R&D claim. And ultimately, if you are reviewed, it's one of the aspects that most people fall down on in relation to R&D claims, should they be further reviewed. Do look also for what is excluded R&D. Not all things, because it's techie or experimental, are necessarily R&D. Things for internal administration, for example, are excluded R&D. There are due dates for R&D, and if you miss them, then there's an inability to claim them. So make sure you're familiar with the timing for when you have to claim your R&D. And finally, it is possible to get advanced rulings to give yourself some certainty in relation to R&D. It again comes back to your risk profile as to whether or not that's something that you want to pursue or not. The second benefit that is extremely topical now and is highly relevant to scale-ups is the early stage innovation company concession. And it has essentially two aspects to it. It's got an early stage limb, and so you need to satisfy various criteria around the fact that you're in an early stage of your business. And secondly, you need an innovation aspect to your business. And the third aspect, although I said there was only two, is in relation to timing. And timing is key for the early stage innovation company concession, or ESIC concession as we usually refer to it. So in terms of the early stage limb, you need to be recently incorporated. Your expenses need to be less than $1 million. You need to have less than $200,000 of assessable income. So you can see it's quite an early stage in a business's progression that this applies to. And then secondly, you need this innovation aspect to your business. And you get that through satisfaction of what we call either the 100-point test or the principle-based test. And they're really what most people focus on in terms of whether or not they get the ESIC concession. Unfortunately, timing is usually left out, and people don't realize the importance of that. And I'll come back to that in tips and traps. In terms of why you'd want to satisfy it, there's two key parts to this. Firstly is, and most importantly, is the capital gains concession. So investors that invest in ESICs can get a CGT concession, basically no CGT, on shares that they held for more than 12 months but less than 10 years, or they get a sort of a 10-year market value cost base should they hold those post 10 years. So that's an incredibly powerful concession. The second part is a non-refundable tax offset in relation to their investment in to the ESIC, up to a cap of $200,000. So quite meaningful concessions, assuming the company can get into the ESIC concession. So if I touch on some of the tips and traps, I think the first thing is when you're looking at this, the ATO has a great tool on their website. You should have a look at it, answer the questions. It's a great way to figure out whether or not prima facie you're eligible. But given some of the other tips and traps that I'm going to talk through, you should talk to your tax advisor about whether or not you're satisfied. Most people come talk to us, tell us they want to register for ESIC. Interestingly, it's not a registration. It's a self-assessment. So you need to satisfy it. If you don't subsequently satisfy the ESIC concession, the investors will not receive the benefits. So it's very important that you do satisfy yourself, that you meet the requirements. Otherwise, those that will suffer are your investors in terms of not receiving the CGT benefit and or the tax offset. And point three here is timing. You really should have a time plan to make sure that you satisfy ESIC at the right points in time. There is no doubt that most scale-ups will do several of the things that are needed to satisfy ESIC. The open question is whether or not they'll do it in the right time to satisfy the concession. The fourth point is around the 100-point test, and this is most people are familiar with. And again, there's two aspects to this. The test will only be satisfied by investment amounts to an extent. You really need that innovation. So that comes through R&D, patent, or accelerator. And the test is quite clear as to what you need to do. Question we often get is, well, what if I don't get the R&D? You need to, go and apply and register the R&D, and it's quite important that you're eligible for the R&D, because again, this will all come back on your ability to satisfy these ESIC requirements. Similar to ESIC overall, 100-point test, timing is key, particularly around people's investment into the ESIC if you're using that to obtain some of the 100 points. The final thing is probably in relation to the principle-based test. It's somewhat subjective. It is actually a subjective test. So there is less certainty associated with it. It is possible to go and get a ruling from the ATO in relation to the test, which, depending on your risk profile and depending on how comfortable you are that you satisfy some of those tests, we often recommend maybe a way to give yourself certainty in relation to the satisfaction of the test. So that's the end of our first webinar series on scale-ups. I thank everyone for their time. It's been fantastic to host you, and I hope you look forward to the next videos in our series. Thank you.